Hello, and welcome to the Joss Brown Podcast. With over 40 years of combined financial planning experience, we will discuss our favorite topics, concepts, and stories.
I'm Dan Joss. This is Michelle Robinson. We work for Joss Brown Wealth Advisors, and today we're going to be talking about tax returns.
Yes.
What we do when we look at tax returns.
That is correct.
And next time we'll have an expert. Talk with them about what they do when they do tax returns and how we work together with our clients.
That's good.
What do you want to talk about first?
Well, this is an exciting topic. Are you excited? I know many people may be thinking, what is excited about taxes? Well, we could talk about what we look for when we ask for a tax return from our clients.
Well, we ask for tax returns from our clients because we want to see their tax return.
Correct.
Most people don't come to us as investment advisors or as financial planners and say, here's our tax return. Much like last time we talked about, they don't show us their estate planning documents either, but as certified financial planning professionals, we want to see as much information about a client or a prospect as they'll allow us to see.
That is
We
correct.
make better recommendations. So tax return's an easy one, maybe the last couple of years.
Yeah, so tax return, when I look at tax return, when clients bring in a tax return and I look at tax return, there are a couple of things that I look for. There's so many things that you could learn from just going through a tax return. Wouldn't you say?
Yeah.
Yeah, so we look at marginal tax bracket. Why we look at that? Because we are looking for what, Dan?
See what tax bracket they're in.
Right,
If they're in a low bracket, then we may recommend a Roth conversion.
that's right.
If we expect their marginal bracket to be higher later in their life. Or if they're in a high bracket, we may recommend not doing a Roth conversion, because sometimes clients will say, well, should I do this? I saw this on TV or I read this in an article. Does this apply to me?
Right.
So when we see their marginal bracket, we just make a note of it, and we don't know what the brackets will be, let alone what their bracket will be in the future, but we have that conversation with clients.
Right. Another thing that I look for is if they're not really at Social Security age, I'm looking to see if I'm seeing Social Security income on a tax return. And so if I see that their tax return has Social Security, then that's a question and a planning opportunity for me with the client. Because if they are not at Social Security age, then in our conversation, I'm going to ask, tell me a little bit more about the Social Security income and why there is Social Security. It could be because they're a widow or widower. It could be they didn't have the knowledge and they decided to take Social Security early, and so that presents a planning opportunity for me. What would you say you do in that situation?
Well, we recommend having the conversation about Social Security with clients, and because you can start it early or you can start it later, and because you can control to some extent that income, you want to decide when you want to take it in for what purpose.
That's right.
So if we say take it early, it's usually a cash flow issue. I need the cash. If we say take it later, it's usually a life expectancy or a longevity risk. If I live too long, what happens? And so in those that have long genes and expect to live longer, we may say wait, get a bigger benefit, or those that don't, then we would consider taking it earlier.
Good. Have you ever asked a client to reverse their Social Security that they have taken early?
Once. And they had to pay it back. But now you only have a year to make that decision.
Yes.
It used to be a longer window to when you could undo that decision.
Yeah, that may be a question for the expert when we do Social Security.
Another thing I look for when I look at tax returns is to see if the client has carry forward losses. And if they don't, and we make a recommendation to the portfolio, we may be able to get losses during those times. And then to make sure that when we do that the tax preparer picks that up and they keep track of that.
And I mentioned that to Philip as well. Yesterday, he and I was having a conversation just about tax planning, and I stated to him that one thing that I look for when I'm with a new client, and if we're going to do a full implementation, that is something that I look for as well to carry over to see if I want to do a straight implementation or a phase out, because of course we always want to do what's in the best interest for the client, because they're the one paying the tax bill, not us.
Right. And rarely, and it's happened once in a while, a client comes to us with all cash. We've got cash invested for us. And we have some in a taxable account and some in an IRA account. You tell us what to do. But usually clients will come to us with some investment. So if our recommendation differs, there is likely to be a tax consequence.
That is
and
correct.
So we want to know what that consequence is before we do it, make the recommendation and do the trades so that they're ready for it when and if the tax bill comes.
That's correct. That's correct. And so non-deductible IRA, that's a big one.
And we want to keep track of that too, because non-deductible IRA contribution is a contribution that you're making that you don't get an immediate tax benefit from,
Right.
if you keep track of it.
That is
And
correct.
if you don't keep track of it on Form 8606, then you'll be taxed again on that withdrawal when you may not need to be.
So we have clients, of course, that some are business owners and some invest in real estate. And so here's another thing that I look for when they come and they said, I have investment properties. I look for depreciation. And oftentimes we realize that some clients are not taking depreciation on their tax return. Let's talk about that for a bit.
Well, I don't know that it's often, but I did have a client that had several rental properties, and we did some short-term consulting with them, and they hadn't been taking depreciation. And their thinking was, well, I won't have to reclaim this when I sell the property. Well, the problem with that is it's not quite accurate. If you don't take the depreciation, you don't get to not take it on the other end.
Right, right.
They'll assume you have taken it.
That's correct.
And so you're just losing the benefit by not taking the depreciation.
I think one thing we must remember when it comes to Uncle Sam, they're always going to expect some money from us somewhere, somehow.
And they'll change the rules. And so that's why we work with experts.
That's right. That's right.
Going back to the tax brackets, if they're in a relatively high tax bracket, that will change our recommendation for bonds in the taxable account. We may recommend municipal bonds, which are federally and sometimes state tax exempt, depending on the state you live. Where if it's a low bracket, we may not recommend that.
Right, right.
And so we'll just say, let's just pay the tax.
Right, right.
So.
And sometimes, too, for our high-income earning clients, we tend to look to see if they're under withholding. So we check the tax, just a quick review, but of course we're not tax expert, so we always coordinate with their tax professional to double check the numbers so that if they're under withholding, then their tax professional can have that conversation with them as to what they need to do and make a recommendation for them so that they're not penalized.
Right. People say, oh, I had to pay a little taxes or I got a little refund. But what they're really thinking about is that catch up when they file the return, not necessarily what they've been paying all year long.
Right.
So it may not be a good thing to get a little too little withheld throughout the year or too much withheld throughout the year.
Right, right.
And just like we coordinate with our clients' tax preparers for those things and business owners and their retirement accounts, it's a good conversation to have with the three: a client, your professional tax preparer, and then your financial planner. It's big decisions.
Yes.
Should I do this year, or could we wait?
Right.
Because, like I said before, we want to know the tax consequence before we do something.
Right. Another thing that I look for is the SEP contribution, just to ensure that what we actually help the client to contribute for that particular year is what's reported. That way, if there is a difference, we could always check to see why there's a difference and make sure that it's being reported. Because of course we know the custodians are not keeping track of that information.
Yeah, they'll just keep track of what they're required to keep track of.
Exactly.
And that's one that they're not required to keep track of.
Exactly.
Just like a few years ago, they weren't required to keep track of cost basis like they are now. And so a good financial planner should be doing that.
Yes.
Anything else?
restricted stock. This is not one that we see a lot of. But it's something that we check for, because while we're checking the basis, we're checking disposition, and just to see if it's vested, if it's actually still being held by the client, or if it was sold and what happens there.
Right,
So we're checking that information.
Yeah, there's a few different pieces that go with that, with the employer's custodian, the client's separate account sometimes, or usually just needs to all get to the tax preparer properly.
Right.
Those are some of the things we look at.
Yes.
And we talked a few times about how we coordinate with a tax preparer, but let's next time talk with a tax preparer, and let's get their side of the story and their clients.
That's correct.
Okay, so that's all we have today.
Thank you.